Welcome to today's Explainer, your daily financial digest. I'm really glad you're joining us today because, well, we've got a lot to unpack. We are staring down a highly volatile, catalyst-heavy market environment right now. And look, the broader direction, it still leans bullish, but this is absolutely not the moment to just buy the dip blindly or, ride the momentum without a seatbelt. In fact, your biggest source of recent portfolio gains might actually be your biggest source of event risk this week, especially when we look at the memory and AI supply chain. So we're going to apply a strict institutional risk control perspective to figure out exactly what's happening beneath the surface.
Okay, let's dive right into this, because this quote right here, it hits the nail on the head. We are officially in a validation week. So what does that actually mean for us? It means we're actively evaluating whether this current sector rotation we're seeing is just a temporary blip or a true structural shift. And we're doing that by weaving together massive macro expectations with some very specific micro risks. If we want to know if the current trend is going to hold, we literally need the upcoming data to validate it for us.
To get there, here is how we're breaking it down today. First, macro pressures and sector rotation. Second, the Micron earnings test. Third, the AI depreciation time bomb. Fourth, master risk control lessons. And finally, positioning for PCE data. We are taking a strict top-down to bottom-up approach.
All right, starting with part one, macro pressures and sector rotation, where we'll look at the macro tailwinds versus the headwinds right now.
So there's this massive global tug-of-war happening right in front of us. Capital is starting to rotate out of the Magnificent Seven, meaning those mega caps are no longer the only engines pulling the indices to new highs. That shifting leadership, it changes the whole game. On one hand, we've got some serious macro tailwinds. Geopolitical tensions in the Middle East seem to be easing a bit with ongoing peace talks, and because of that, oil prices have dropped back below $80 a barrel. That's a huge relief valve for global inflation. But on the flip side, we've got severe macro headwinds pushing back. We're staring down looming rate hikes and some really complex international currency dynamics that could tighten financial conditions right when the broader market is trying to run.
And speaking of those rate hikes, just look at this number, 100%. The bond market has currently priced in a 100% probability of a September rate hike under the new Fed chair, Kevin Warsh. The bond market is essentially saying, yep, this is a done deal. Unlike previous Fed regimes that, might have tried to talk the market out of this expectation, the current stance seems to just validate it. And the so what here is simple. The cost of capital is going up. That directly impacts how we value high-growth sectors, especially the ones leaning heavily on future earnings.
Then, you have to add in the whole Japanese carry trade situation. You've probably seen the headlines about the Bank of Japan hiking rates, which theoretically makes borrowing yen to buy global assets more expensive. But the nuance here is absolutely critical. While the BOJ is hiking slightly, they're also continuing quantitative easing. Essentially, they are printing money while raising rates. So the real risk to global liquidity isn't just the rate hike itself, it's the broader US dollar to Japanese yen exchange rate. As long as yen depreciation remains the key driver, thanks to that ongoing QE, the carry trade survives. But if that currency dynamic suddenly snaps back, oh boy, that's a systemic risk you absolutely need to keep on your radar.
Moving on to part two, the Micron earnings test. This is our microcatalyst deep inside the memory and storage supply chain.
When we look at Micron, or MU, we run into what I like to call the MU paradox. Seriously, think about it. Why is it that a company can completely shatter earnings estimates, significantly raise its forward guidance, and yet watch its stock completely sell off the literal minute the report hits the wire? It defies basic retail logic, right? But honestly, it makes perfect sense once you look at it through an institutional pricing lens.
And the historical data brilliantly illustrates exactly what I mean. If we track the post-earnings stock reactions from Micron over the past 8 quarters, the company beat estimates nearly every single time. Yet in 6 out of those 8 quarters, the stock dropped immediately after the print. Crazy, right? But the market isn't reacting to the fact that they made money. The market is reacting to how those new earnings mathematically alter the valuation of the company moving forward.
So the crucial concept to grasp here is forward PE compression. This is the institutional mechanic driving those sell-offs. Here's how it works. When management announces a massive upward revision in expected earnings per share, the denominator in the price-to-earnings ratio explodes upward. Because earnings are going up so fast, the PE multiple compresses. Right now, Micron is sitting at around an 11x forward PE. Now, to the untrained eye, a dropping PE makes it look like the stock is struggling. But actually, scratch that. It's because the fundamental earnings growth is just drastically outpacing the stock price. Institutional algorithms often re-rate the stock down temporarily as this mathematical compression happens, even when the underlying business is absolutely booming.
All right, Section 3, the AI depreciation time bomb. Let's look at the structural vulnerabilities, kind of just hiding in plain sight.
To truly understand the sheer scale of the infrastructure being built right now, consider this wild stat. 68.4% of all North American internet traffic is now driven by AI agents in machines, over 2/3. Not human beings scrolling, but machines. These AI agents doing tasks like scraping thousands of sites simultaneously create a massive, massive demand for cloud computing, storage, and processing power. This insatiable demand is exactly why companies are pouring hundreds of billions of dollars into AI infrastructure. But, and this is a big but, this massive capex sets up our next major risk.
Legendary short seller Jim Chanos recently brought up a theory that should genuinely make any tech investor pause. He calls it the depreciation time bomb. See, data center operators are buying these incredibly expensive AI chips, and on their accounting books, they're spreading that cost or depreciating it over about 6 years. But here's the messy reality. AI hardware technology is advancing so incredibly fast that the actual competitive lifespan of one of these chips is really only 3 to 4 years.
And we already have the data validating his concern over this rapid obsolescence. Rental rates for NVIDIA's previous generation Hopper chips have already dropped by roughly 28%. Think about what that means. If the hardware loses its pricing power and competitive edge in 3 years, but the company's still slowly paying for it on their books for 6 years, those paper accounting profits are basically an illusion. The moment they are forced to adjust those depreciation schedules to match reality, their margins are going to violently compress. That right there is the time bomb.
Which brings us to Section 4, Master Risk Control Lessons for Surviving Volatility.
Look, if you're feeling a bit of economic anxiety right now, you're definitely not alone. So how do the really sophisticated investors navigate this kind of environment? We can actually turn to the master risk control lessons of legends like Seth Klarman. Klarman is famous for running extreme mental models before he ever allocates a single dollar. Back in 2008, when everyone else was panicking, he stress-tested his potential bond buys by assuming an 8 times increase in default rates. He literally assumed 40% of his underlying portfolio would go straight to zero. He asked himself, if the absolute worst-case scenario happens, will I still survive? Only when the math showed he wouldn't lose his shirt in a total catastrophe did he buy. And we need to be applying this exact logic to our AI and tech holdings today. If capital expenditures suddenly slow down, or if that depreciation time bomb goes off, can your portfolio survive the shock?
Finally, Section 5, Positioning for PCE Data. Let's bring this all together for the final synthesis.
So we've evaluated the institutional logic behind the Micron trade. We understand the hidden structural risks in the AI supply chain, and we've got our risk control hats firmly on. Let's see how this builds, because this is how you must structure your thinking for the week. Step 1. Evaluate the market's reaction to Micron's earnings. Does the forward PE compress as expected, or does the market just shrug it off? Step 2. Analyze the upcoming PCE inflation print. If inflation is cooling, maybe thanks to those falling oil prices we discussed earlier, it might soften the blow of that 100% priced-in September rate hike. And Step 3. Combine these signals to either confirm or reject the sector rotation. If Micron shows vulnerability but PCE is cool, then that rotation out of big tech into smaller caps and other sectors is very likely validated.
I want to leave you with this provocative thought as we navigate this validation week. Will the upcoming macro PCE data give the market the green light to confidently rotate into new sectors? Or will the micro data from companies like Micron expose that our entire AI infrastructure boom is resting on a structurally fragile foundation? The numbers are coming, and now you have the framework to interpret them. Keep learning, stay focused, and I'll catch you in the next explainer.